Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And roll time, right? Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got these time. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Go back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Oh man, am I not getting the camera here? Hold on. We'll go fix that. Come on. Oh, you know what? Because it's not plugged in. Oh, what's wrong with me? Man, what a disaster of a start for the morning. So I had to take the kid down to an activity, and they were like crazy late because they couldn't find something, and that's why the stream is starting late. The first time that one's happened like that. But okay, let's go to the charts here. Okay, so S&P 500 did pretty good yesterday, just kind of like a panic buy out of nowhere, but yeah, we're still within range here. And the 10-year also saw a pretty aggressive move up out of literally no. I mean, I don't know. I felt like strong trend. Was there a good reason for it? I don't know. I feel like I'm out of the loop here this morning, pushing down quite aggressively off of the open, but bouncing back. And I'm not so sure that that is driven by any news either. It may not be fundamentals driven, may retrace. We'll see. Oil trying to push higher, but not really running yet, but it is new highs. And then we got silver and gold back into the range and just going sideways. Silver not looking so hot in comparison to gold, and Kappa kind of in the middle as well. And then we got the currencies. So Bitcoin has just been like back and forth, man. This is just like the craziest. You know what this reminds me of, right? So you remember that whole thing about Bitcoin? It went like this, and then it went like this, and then right? You remember that? Back in like what, 2018, 2019? That's what that looks like to me. Past performance is not indicative of future results, though, folks. Oh, wait. The dollar. Well, the dollar's not doing anything interesting, so I won't bother switching it back to that. We're already selling, but I'll tell them to wait. Now, make them come back. There's no reason they can't come back for me. Don't you think? Nah, I'm not going to trade. Like, I still have this swing trade on, of course. I don't think that's the most that it's ever been at, right? No. Because at one point we were down at 117.21.5. 21.5. Way down here was where we were at, like, what, 2 days ago? I feel a lot of FOMO because it's moving and I'm not trading it, but I'm not going to trade it, dude, today. I don't know if I actually slept last night. Like, let's see here. I remember getting to bed at 11. I remember waking up. I think that I might have gotten 3 hours there. Waking up with the baby, and he was just screaming bloody murder. I'm like, honey, that is not a I am hungry cry. That is a I am in extreme pain cry. Except for the problem with babies is that, like, they will like cry and cry and cry over small pain. So like in my mind, it's like, oh no, he's dying. He's gonna start pooping up blood. This is awful. But I think it was just saying he needed a diaper change. Anyways, so that went on for a long time. So I don't think I got more than like 4 or 5 hours of sleep last night. And that is not a good position to be taking trades. I was thinking, hey, well, you know what? We can take this whole week off. Can just stream and not trade this week. But now I'm thinking, man, I don't know if I'm be able to trade for a few weeks. The way that this is going. But Yeah, I don't really see fundamental reasons for these moves here. Kind of looks to me like we've got a quiet market and some big players coming in and doing things, and no real reason for it. It doesn't look like there's a really strong correlation between these moves and any kind of change in fundamentals, right? Oh, that's not right. There we go. Consumer sentiment is getting squeezed. Wow, San Francisco outs Soros backed uber regressive the DA in recall vote. Well, that's going to be interesting to see how that one turns out. Futures drop as yields push higher. Hawkish ECB looms. Well, okay, so that might be it. Let's see here. We got the 10-year note auction today. Well, I already got a swing trade on, so I think we can just, well, I'm kind of thinking about loading up at 118. Because they're right. So one thing I remember reading this morning is that periphery yields are like skyrocketing, and that's not very good. But that the ECB continues to be very hawkish. The other thing is that we've got the 10-year note auction, and I have some concerns about the Federal Reserve buying less. I think that it's going to be more in the short dated the short dated assets that the Federal Reserve is going to roll off. So I don't know if it's going to be the 10-year as much, but that's one that we got to watch. Like there's a scenario here where the 10-year note auction is just an absolute effing disaster, right? Auction days are the best to take opportunities early on. Well, I don't know about that one. Like the thing that's interesting about auction days is that you'll continue to have activity, although they very often will settle on a price and kind of stick to it, right? But there's usually a move after the auction, and sometimes that move is better to play. But also, like a lot of what you see early on is just kind of like a mess sometimes. So what we need to keep an eye out for is like if there's any big icebergs or anything. But again, I'm concerned that there's not going to be enough demand. Oh, by the way, I need to. I'm gonna fix my lighting there. I actually got a new light. I don't know if you can see. You see how there's like a little black line in front of the shelving? I put that light there. But you know what? It does such a good job. I think I'm just going to keep it like that. Super important levels in the German index. You get tons of volume at random prices firing off constantly. Well, yeah, this is why, like, I've traditionally, okay, like in the post-pandemic era, I would say I've gotten some pretty good trades off of auctions, right? But pre-pandemic, auctions were always very difficult for me. So whereas after the auction, I got to tell you, some of the best trends come after the auction. It's just like the auction's over, and then it just goes up for the rest of the session. That happens a lot. I don't know if that's what's going to happen today, though. Might be down. But here's the good news for me is that, it's the good news for you too, is that you don't have to take a trade if you're not sure what it's going to be, right? I think that the play would be down. I think that the play is, that's the way that the trend is. So of course you want to sell it, right? But I think that the reward is on the side of the auction ends up going terribly today, right? Maybe you became really good at trading them. I don't know. I don't think so. The point that I was trying to make there is that auctions have behaved differently post pandemic. They really have, right? We have seen you remember all of those days where the auctions went so badly that like the S&P 500 sold off, right? Back in March, right? Like that was something that never happened. You know, I think that before the pandemic, that we here on this channel really underestimated the importance of auctions because we didn't really have a very good experience on, you know, how much it matters. Like you were never really seeing outliers in the auctions where a ton was being put out or that the demand like really suffered or something like that. And so you didn't get to see how critical uh this is to the functioning of our market. You know, it's just like the auctions are the equivalent of the gasolines and crude oil stock numbers that they put out on Wednesdays, right? Which they'll put out today at 8:30, right? It's just as important. It's just that there doesn't tend to be very much variation in them. But then post pandemic, there has been serious variation in them. So now, since that, I've kind of learned that, oh, really what you want to do is you want to know, okay, this is how much they're putting out, and this is how much demand we're likely to see from the market. And there's probably ways that they estimate what that demand is going to be using data and sources that we don't have. And then it's the same thing, like every day you'd want to come in and see how much corporate investment grade bond issuances there likely to be today. And that could also be a significant factor in how the treasuries move that day. That again, we don't really have very good data for. So, but this move, just to kind of put things in perspective, though, this move that we're having here off of the open, I'm kind of a little meh. Like, it was a strong move off of the open. It's retracing quite easily. We've seen that a lot this week, right? Move down, completely retraced or even reversed. Like somebody probably had a large meta order and their strategy is it just executed at the very beginning when the market opens. May not have any fundamental value whatsoever. There may be no informational content in that huge meta order sell that we had at the open, right? I'd still probably rather be with the trend though, right? Well, I have some food here. Let me eat this oatmeal. Okay. Maybe oh, I thought you made another comment. Maybe you became really good at trading. I thought you said maybe you became really good at trading then. No, I think that the biggest thing that I've learned over the last 2 years is when not to trade. I always find it a little amusing when people come in and they're like, "Well, why haven't you taken a trade yet?" It's like, 'cause there's no trade to take. The less trades you take, the better, guys. Unless you're like market maker, unless you're a robot. Oh, looks like Mohammed El Ran was on the Squawk Box this morning. The Fed has been late when it comes to pumping liquidity. When it comes to making the difficult decision, this Fed in general has been incredibly slow, says El Ran. If I were fully invested right now, I'd take some chips off the table. No, I don't agree. So I agree that the Fed tends to be late. I disagree with the notion that the Fed needs to be pumping liquidity right now. The issue here is that the market has been pumped up for so long that really at this point they need to raise rates, and if it creates some pain then so be it. Like, really, because we have to come back to an equilibrium, or we're just creating a larger problem for ourselves down the line. And if the market can't handle like a neutral interest rate policy, which would be like 3%, okay, then I don't know what to do for you. You know what I mean? You try that new financial? No. What are you talking about? Like they have a site that's specifically for breaking stock stuff? You talking about breakingstocks.live? I think it's called. Like the unusual activity one? Because not really interested in trading stocks. You know what? There's well, not this is like a big subject. I shouldn't get too deep into this yet. Looking for bottom end euro bond. Does the I can't see the euro stuff, but it does seem to me that the euro has kind of been leading the way past week or two, right? There's that. The further along, I got to tell you, like the thing that continually frustrates me in the last few months is that the deeper you get into this, the more aware you become of the information that you don't have. And or you would like to be in this position where you just know everything, but the reality is that you can't. There's always going to be some pieces of information that you don't have, and I would much rather be in the position of knowing what kinds of information I don't have, knowing what I don't know, rather than not knowing what I don't know. But it's really frustrating. Because I've been going around trying to find, like, there's a piece of data. It's like, okay, how do I get it as a retail trader? If I had a Bloomberg terminal, I'd be good. But how do I get it as a retail trader? And I can't find them. Do some research. Help me out here. Look around. What is the best cash bond market data source for a retail trader? Like, I'd be willing to pay up to like $50 a month for it, maybe. But like, well, I think that even up to $100, I might not do it if it's out, but I would still like to know if there's an option that's like under $100 a month, right? To get cash bond market data, data about corporate issuance, right? These are kind of some of the things that we know are important and we don't really have access to. The unusual activity, I don't know. You don't trade stocks, baby. Well, I think that the unusual activity thing might rely on options activity, right? For futures, here's what I do for futures, Lucas, is I've got this, well, I'll pull it over here. I'll pull it over here to the bottom right. So I have my market analyzer, and for Jigsaw, it's best to have this a market analyzer with the Jigsaw connection in one of the columns, right? So I just, I kind of expanded on it a little bit. So here I can see, okay, like what is actually moving today, like in terms of direction. 6J is getting hammered pretty hard today, right? Probably a big key behind the degree of the sell that we saw this morning. Silver's not doing so hot either. What's with silver? Well, yields are rising. The whole bond complex is kind of leading the way so far, right? What's up? Corn, oil. It's funny that it's the commodities that were the hedge, not gold or Bitcoin or any of those things. It's kind of like what all of the economists told us for all of these years. I feel foolish for buying any gold, and everything that I put into gold, I should have put into corn. Anyways, but then I have this one column in here. This is AMA. This is one of Lizard indicators, right? Relative volume. And so this is showing me at this very moment what is moving the most relative to what it usually does at this time, right? So then what does it tell me? Soybeans and copper. Okay, well, so what's copper doing? Oh, copper looks like maybe it's rising, but it's pretty choppy over there, right? Yeah, you want a net change that resets with a hotkey, or I agree. They're working on like a bunch of other stuff, and I don't really know what it is that they're working on, other than that it's probably more important than what I want. But I really want to see Jigsaw create a market analyzer, and that when every time that you like global recenter your DOMs, it would recenter the net change. Yeah, I totally feel you. Now we might be able to make something that you could push a button and it would tell you the net change since you did it, but I generally don't care unless it's like one of the ones that I'm watching and I can see that from the charts and stuff like that. This is kind of more like the overall market view kind of a thing. And I think it's good to have an overall market view. Right. So, yeah, brokers have trust solutions for correlations. Exactly. That's exactly, you're right on, man. Like the one of the most well-established profitable trading methods that we know of, one that's so well established that it's basically out of reach from retail traders now because the robots dominate it, is all based on correlated assets. Right? That's a large part of what the robots are doing here. Is they're saying they're sitting there, they're watching this currency movement in the 6J and then trading the treasuries accordingly. Like that's what a lot of these robots are doing. Right? And yet almost all of the trading platforms, well, you know what the problem is, though, Lucas, right? Is that the trading platforms do not optimize for what makes people the most money. They optimize for what gives them the most customers. And people are more interested in charts than they are anything else. And the more sophisticated and fancy, cool looking the chart is, the more interested people are in it, right? And so except for Jigsaw, which focuses primarily on the DOM, but pretty much everything else is, let's how fancy we can make our charts, right? And so yeah, they don't have these things. You know what I thought was crazy is like co-integration. So co-integration, if you're not familiar, is kind of a similar concept to correlation, but what it says instead is like, this asset is tied to this asset, but it's like within a range of sorts, right? So this one is like tethered to this one. It can only move so far away from it, right? So co-integration is a key concept, okay? And there's all sorts of fancy math that you do to get co-integration, okay? There is no co-integration indicator for NinjaTrader 8. So with the best platform out there in terms of like ecosystem, nobody's made one. Somebody made one for NinjaTrader 7 and I converted it over to NinjaTrader 8 by hand. Right? There's not one for 7. Isn't that nuts? And there are a number of models and mathematical calculations that are commonly used in the quant space that you never see retail traders talk about. Is it volume pre-market? That's a good question. I forget. Let's see here. So if I come into columns and look at the settings of it, Give it a second here. I feel like it might be time for me to like reset my database in NinjaTrader because it feels like when I'm modifying the charts and stuff, it's not very responsive. Okay. So calculation mode is day of week. Oh, I don't know what that means actually. Reference period in days is 10. Relative volume. I don't know what day of week or all days is, but it does a pretty good job of putting the assets that are having the most unusual movement at the top of my list. So well, here in the last 15 minutes or so, gold is at a pretty solid reversal back up. You know, like the treasuries, they retrace a lot of that move, but gold and silver like really reversed. Look, somebody posted in the treasury. Oh, somebody, they said this back in February. They're kind of looking at the same thing that I have. Well, I'll comment on that later today then. Because trying to just do a conversion factor doesn't seem to work. It changes too much. Mm-hmm. Oh, here we are. I was interested in this jigsaw thread because somebody was having an issue. I want to see if they posted more information, but no, I guess not. Never understood how anyone thinks they can use latent volume profiles. Well, that's not what they're doing. I think you don't understand the tool. This person right here. Did you make the wifey poo read AI book? No. Dude, like you know what the thing that's really frustrating about having a baby, like when they're brand new, is that it seems like you have all of this time to work on things, but in reality you don't. Like if I stay home the first week, I might stay home the second week too, man. The pace that things are going right now, because I'm not getting much sleep, right? You're just not in a good enough state to really get a whole lot done during the day. At least not for me. I don't work very well on low sleep, right? I need like my 8 hours, 7 to 8 hours, or I'm compromised, you know? But this one is being a little bit, well, I'm hoping maybe we're over that. It's getting better, but this one has been a little harder to please. He was great in the hospital. He was just the perfect baby in the hospital. But since we've been home, my wife has been having lots of problems with him. So I kind of want to get her into programming. I don't know if I could actually get her to do it. You know what I really think she would be good at though? Is video editing. I'm having a hard time getting her into that, but I think that she could get really into it. Like she has the kind of mind for that sort of a thing. But I don't know. I think at one point I'm still eating, so I haven't gotten too deep into a bunch of things. So that's the second thing we got to talk about. Like I'm kind of thinking about building a new machine, but there's so many different things that I could do. I'm kind of in the middle of building a desk, and I could probably pour so much money into the desk. I was looking at monitor arms, and I've been having a hard time finding the monitor arm that I think is like, oh, this really actually truly fits my needs. Well, I finally found one that I think is perfect. That is like, this monitor arm is going to truly do what I want it to do. And it's like $350. So I didn't notice anything special about PewDiePie's desk. What exactly is cool about it? I gotcha. Well, my focus right now with my desk is to try and get more room directly in front of me. So I have all of this stuff, and I got an extra long table so that I could fit it all on there. But the reality is, I can't reach this keyboard. It's too far away. I can't reach this DJ console thing. It's too far out of the way. And so, really, to do anything, I have to move it over in front of me. And the mouse and keyboard take up all of that space in front of me. And this desk is only 2 feet deep, right? So, I think what we want to do is get like a table that's 3 feet deep and have a keyboard tray so that the I have more room to be able to move that keyboard and that thing right, so that all of those peripheral devices can be right in front of me and I can reach them without having to move anything. And then I'll still do some moving, but it'll be like move the keyboard off to the side so that I can move the fight stick over there or whatever it is that I'm going to do, right? Yeah, that's what I mean by wide depth. Yeah, depth. So I think what I'm going to do is I'm going to make it like I have a piece of wood that's 3 feet. And I think I'm going to like cut a notch out of it like that for me to sit in so that it's like this. Right. And then there will be a pull out keyboard tray right here. So I can get really close to the desk if I want to, but I don't have to. And I'll still have this keyboard tray. I don't want it to do it like 3 feet and then the keyboard tray, because then I would definitely be too far away from the monitor. So, but having the keyboard tray in there kind of gives me this room. And then hopefully I can have my peripherals right here like this, right? Right. And then I can have even more stuff over here, like taking notes and so on and so forth. So that's kind of what I'm thinking. But then the other thing is right now I've got this monitor arm that's like this, right? And then I got the monitors like this. Okay. And then I have these speakers behind there like this. I don't know if you can see that very well. I got these speakers behind here like this. So what I would like to be able to do. Oh, there we go. Yellow is way better. What I would like to be able to do is to be able to move the monitors way out to here if I wanted to, right? So what I think I want is, instead of having this triple monitor arm, I'm just going to have 3 monitor arms, and I'll mount it all the way over here so that I can move the arm over to here or way out to here, right? So if that's the case, having an arm that has a really long reach, I think would be really useful. And also like a good gas spring arm and everything. So one of the problems that you get with monitor arms, I come over here, I was searching for PewDiePie's desk and I was like, oh, I don't see anything special about it. Okay, Amazon. So if I go to Amazon and I look for monitor arm, okay, well, There are some cheap monitor arms. Something that I notice a lot though is that they have this thing, right? You see this angle here? They've got this angle there, right? So what that means is that if you were to put something right here, if you were to put something right there, you might not fit. You might have problems with it, right? So then you get the ones with the post, right? The post kind of moves that arm part up so that you have more room directly under the monitor, which is kind of like the whole point of the monitor arm to begin with, right? Is to be able to have that space underneath of it instead of having a this big stand there. You can use that space for something else, right? So having a post is pretty good. But then there's like limitations on how far out they go and yada yada yada. Also, there's a lot of monitor arms that just they look like they're so there's that style, but so many of these look like the same thing. It's like, okay, this one right there, this Huano looks exactly the same as the North Bayou, right? There's another one that's kind of got a circular thing. Where is it? So how far I have to scroll down. This one. So there's these other ones that have a little circle thing right there. Right? The circle, right? Yeah. So it's just like it's like all coming from the same Chinese manufacturer, it seems like, except for Ergotron. They seem to be making their own. There's one that's got pretty long reach. Right? There you go. There's a better example of the one that's circular, right? Now there's one that I do find interesting is there's this gaming monitor arm. This one right here. Oh, look, they're not the only one that has it. Okay. Mount Up had one. Mount Up has one. Apparently, these guys have it too. It's the same monitor arm. So, like, clearly, some Chinese manufacturer is making this arm, and like multiple people are selling it, right? Their stuff doesn't. So the interesting thing about this one is that instead of using a gas spring, it uses a mechanical spring. Most monitor arms use gas spring arms, but the problem with gas spring arm is that they aren't as durable, right? And I've heard a lot of IT guys say that when they buy these cheap Chinese gas spring arms, that about 50% of them die after 2 years, right? So having a mechanical spring is going to last longer, might be useful, right? This one just looks cool, but it's still, you can still see how if you had an object on the desk sitting right here, you know, it would kind of block it, right? And then how far do we go? This one goes out to 20 inches, right? And most of the monitor arms that I've seen go out to 20 inches, okay? So enter the iMover. This is what I think I want. Okay, $350. So $350. I think that's overpriced personally. That seems overpriced, but for one thing, they have like a 15-year warranty on their gas spring arm. So that tells you you're getting a much better quality piece of equipment there, right? And the interesting thing about this one, okay, so it is a pull, but it also has this kind of like, there's a little piece right there, and then there's another little piece, and then there's the arm, and then there's the gas spring part, right? So this one can go out 34 inches. It can extend 34 inches. So in terms of your flexibility for where you orient it, this is it. This has the most flexibility out of anything that I've seen. And you can put whatever you want underneath of that arm. and you got a pretty decent amount of clearance. I mean, if I'm moving my arm all the way up there and I just keep this arm part relatively low, right? So I think this is the arm that I want. But I was able to find a 15% off coupon, but that still puts you at like $600 for 2 of them. No, thank you. No, thank you. Can you drop the link? Yeah, here it is. I should ask them if they have like an affiliate link, because if there's like a monitor that's like, okay, this is the best of the best or whatever, I think it would be this one. They have 6 monitor arm ones too, but they're not very, here, I'll show you. They don't show you very much, unfortunately. 3 to 6 screen monitors. See, you see that, but I can't see the back. Right here, this 6 screen one right here. It shows me, okay, so it is a electric adjustment, so you can electric adjust it up and down. You don't get the back view. Maybe there's a video? Remember there's a video? Yeah, that's kind of what I thought. Is it'll have a central thing with these poles that come out, and then it looks like you get these little things that come out so that you can angle them around. So probably not as flexible as I want. Plus, it's like $1,000. Plus, it's like $1,000. But if I was to recommend something like this, if you want a nice monitor arm, it looks like this is it. I of course would need to try one out, but it seems to me that these are the most flexible. Hey, maybe actually it's not so bad. Like, I don't think that I need like a motor in it, but that might actually get you further out than what I have right now. It might actually be better. Yesterday I was looking for images and I couldn't find them, and now I found this, so that's kind of cool. In the documents. But I don't know. Like, if you go online, you don't find anything about them. Like, even though they're like the highest quality stuff I can find. Probably because everybody's going on Amazon. Right? But I think I'm going to wait. I think I'm going to get the desk first and see where we're at. And then if the monitor thing still bothers me, then I'll splurge on it. But I don't want to spend too much on the desk because we could build a new PC. That would be way more fun. I don't really need a new PC right now. I don't think I do, at least. But it would be really nice. Be really nice. So, and then I could probably take this machine and like turn it into something for my wife, like have my wife do video editing on it or something. So I was just going there at the 10-year because we've kind of come up and there was a little bit of a pocket, but now they're like at the higher end of the range at 0.3 and they're kind of doing this low liquidity thing. So that really does suggest to me that they basically got sucked all the way back to where all of the liquidity traded in the pre-market. Bitcoin is popping? What are you talking about? Pretty. They popped last night, and then it was a BART. The crypto space really looks like the let me pull up a probably time that I post an update with my updated charts for Bitcoin. It's been a little while, but I was waiting for something more significant to happen, and it just hasn't. Traded it last night. Well, there's always moves big, but you can be on the wrong side of them too, right? But, there was a point where in 2017 where Bitcoin kind of came down, and a lot of people are saying, oh, well, this is a bottom, It went like flat forever. And then they thought, well, it's going to bounce back up. But that's not what happened. It plunged lower, and that was a really ugly shakeout. But after that ugly shakeout, I think that was probably the lowest that it ever got, right? In the last cycle. Could be wrong. There we go. Oh, wait, what? No device. Is it not exporting? Oh, it did it. So like this, right? Obviously, the context of it is different. The context of it is a little bit different. Oh, jeez. This thing right here, right? Kind of went flat for a really long time. It was flat for much longer than this has been, and then it eventually dipped further. This looks really similar to me, right? Although I would say that I think that a lot of this was like just them pumping it, like the interest in Bitcoin I don't think is actually there. Like what I see is a bunch of people that are like really enthusiastic about it, trying to convince everybody else to be as enthused about it, and people not really going. In fact, if anything, people turning against it really these days, right? Anyways, that reminds me of that whole thing. So remember the other day, Bitfinex was going on about this person that claims to have like these leaks from Telegram. That got wider play than I thought, but like hardly anybody believes that he's actually going to deliver. If this guy delivers, it's going to be like an earth-shattering event, but I don't think he will. I don't think anybody believes him. And he says he has like 138 gigs of logs. Like, what? There's no way. Oh, Treasury moving up a little bit still, yeah. I'm glad I didn't add at 118. Probably with the way that I'm managing this, I should probably wait for a really strong move against me to add. Anyways, so the other thing we're just going to talk about is the rule changes, right? The SEC is proposing some rule changes that would affect stocks and essentially destroy payment for order flow. Although how it would actually work is unclear to me, because it sounds like they're saying you can't just route your client orders to one person, that they have to compete for it, which I suppose means that those wholesalers or whatever will put up their best bid offers or whatever and compete for it, right? But I don't think that means that they get rid of the wholesalers, right? I don't think that it means that everything goes to the exchange like it does in futures like the CME. So I don't think that they really fixed the problems. But for me to trade stocks, they have to fix the wash trading rules. So there is a way around the wash trade rules. So if you're not familiar with them, basically, if you sell a stock and you take a loss on it, you cannot buy that stock again without running afoul of the wash trading rules. And if you do that, it's basically you can't count that loss against your income, essentially, right? So if you're like trading all day, taking thousands of trades, and all of your trades run afoul of the wash trading rule, then basically what it ends up meaning is you will have to pay taxes on all of your profits, and you won't be able to discount any of your losses against it, right? So that really sucks as if you're going to be a market maker. Now there's a way around it. There is a way around it, and that is you can elect to use mark-to-market rules to pay your taxes. So when you do that, you are paying. So there's two disadvantages to that, right? Number one is that all of the income that you generate through your trading activity gets counted as regular income, even if you held it for a long time, right? So if you're like doing a little bit of scalping and holding some stocks for the long haul, like I am, then you're going to pay extra on your stock profits. The other issue is that you have to pay your profits at the end of every year. So if you hold a stock and you've made money on it, you have to pay taxes on whatever it marks to market at the end of the year, which is like problematic. And then the other disadvantage of it is that you have to do it at the beginning of the year. Like you basically have until you file last year's taxes to elect to do this, and then you can do it going forward, right? So that's kind of a big commitment for a retail trader, right? If the wash trading rules didn't exist, I think you'd have a lot more liquidity in stocks. But I feel like that if the holding period of the stock, like when you started the position and ended the position, if it's intraday, then it should just be treated as short-term income, and the wash trade rule shouldn't apply to it. All this complication that they have, like it really seems like they didn't really think this out when they made that law. And there's all this weird stuff about there have been people that sued because they had to pay a ton because of the wash trade rule, and like whether or not you qualified for it, and they were like clearly day trading and they still lost the court case. That's kind of weird. Don't you guys have ETNs? I don't think that matters to that. It's the owning a stock. Doesn't matter how you own it. Futures are like a fundamentally different sort of a thing because it's a contract. But yeah, so for me to want to be interested in unusual moves in stocks and trading stocks, like that would have to change first. But I'm not as into the what's going to be hot today and then go and try and trade that off of a chart pattern or something. I'm just not into it. CFDs, but CFDs are kind of a I wouldn't recommend trading CFDs. Let's put it that way. CFDs are a lot like Forex, where the instrument is kind of constructed in a way that kind of screws you over, right? Where they're trading against you, and yeah. Hmm. An active inflation blame game with the administration rather than the Fed on the receiving end. What makes all this even more frustrating is that the widening of inflation concerns, social, economic, political, financial, and institutional, was predictable, partially avoidable. Uh, it's really interesting to me how over the last week or so, how much focus Janet Yellen has gotten. Yeah. And that was pretty good at '05, but they came back really hard. Not much correlated with it. S&P 500 is running here though, right? Well, not running in a direction, but I mean it's trading. Um, hmm. I think the reason I have the Janet Yellen thing on my mind was that somebody responded to a comment to me on Reddit, and I thought that that person was particularly insane. It was like an anarcho-capitalist that responded to my post, and I was like, oh, no, screw these people. And because I really think that a lot of our problems that we have in the economy today are really generated by politicians. Everybody wants to blame the Federal Reserve, and I really think that the Federal Reserve is doing the best that it can given the circumstances. Um, People have this idea in their mind that the Federal Reserve has to get it perfect and be ahead of the curve every single effing time, and if they're not, then we should abolish the Fed. Like that's what people online say, and it's nonsense. I mean, it's a discretionary system. It has to be a discretionary system. It's better. It's better than what we had before, right? And yeah, they're going to make mistakes. But you know what? The Federal Reserve, we wouldn't be in the position where the Federal Reserve could make such a mistake if not for the irresponsibility of Congress in the first place. Right? And the economists told Congress what was going to happen, they ignored it. So why are we blaming the Federal Reserve and not Joe Biden? 100% agree. Or frankly, to some extent, Donald Trump. Like, look, if the Republicans and what Donald Trump was president and Republicans had a majority in the Senate and the House of Representatives, I think they would still pass stimulus, but it would have been very different and not as much, right? So it wouldn't have been bad, but Donald Trump put a lot of stimulus into the economy before the election too, right? So the Republicans and Democrats share in this. And by the way, thank you for the congratulations on the baby. So you guys watch, you do see the image posts on YouTube. That's good. Okay, so this is an interesting. When you said this is a triggering opinion, I thought you were going to say something actually controversial. But instead what you're saying is not so much controversial as it is like something that I just haven't heard before. Every single monetary and financial problem in the G20 has been a direct result of the Bank of Japan's actions since the mid 90s. No other central bank, no government. Well, that's hard for me to say how that fits in. I don't think I know enough about how that affects things. I think that when I say like let's look at the politicians, like what I see is a political class that is more interested in maintaining their own power and enriching themselves rather than actually fixing anything. So the fact that Republicans had a majority in the Senate and a majority in the House of Representatives, and they owned the presidency, and they couldn't rescind Obamacare. The issue that like the whole modern Republican Party basically based on, because like look, when Obama became president, Republicans got hammered, okay, people did not like Bush. They very much were telling the Republicans that they're not happy with what they've done when in 2006, when the Democrats took over the House of Representatives and Nancy Pelosi took over. And ever since then, it's just been ugh. Like, okay. And so Obama came in, and what did he do? He pushed really hard for Obamacare, which the Republican Party just universally despised. And they were able to pass it, but at the expense of basically their entire political agenda ever since then, right? And so that ever since then, we've had like 10, 15 years now of like Congress does nothing, all because of Obamacare, right? And so the whole thing was that the Republicans were elected to get rid of Obamacare. And then when they had the chance to do it, they didn't do it. They didn't do it. And there's this, and there's education. That's the other one, is Obama, made all of these programs to make it easier to get student loans. What a disaster. Everybody said what was going to happen when they did it, and it's still there. How is this still happening? That we're still subsidizing colleges instead of saying, well, no, you're going to have to go and get a loan on the free market, and it's not going to be a very pretty loan, and you're not going to like the terms, and a lot of you aren't going to be able to go to college. So maybe the universities are going to have to adjust their business model and not charge you so effing much, because the costs of universities just keeps going up and up and up, and it's insane, right? That in healthcare, politicians haven't done darned thing about either of those things. And it's the Republicans didn't do it either, even though I think that in theory they have some solutions that are maybe better, right? And then you can just kind of see these are like the best examples, but there's just these little things all over the place, right? Especially in the financial system. Why are we still using mark-to-market accounting rules to determine how much margin people can have? Okay, that is being abused. We've seen it abused. They haven't done anything about it. Why do we still have the mark-to-market rules? Why do we have all of these intermediaries in the stock market when we don't need them anymore with our technology, right? When are we going to modernize the microstructure of the stock market? I don't get it, right? It's all of this stuff all around. And you add all of these little inefficiencies here and there up, like they add up. How are you ever going to get to 3% growth again if you don't fix these problems? I don't think you can. And so the Federal Reserve, they can come and they can cover for you by enacting monetary policy that tries to smooth out the bumps in the road, right? But really, in the end, what it's doing is it's allowing the politicians to just push it off and push it off and push it off. And what eventually is going to happen is they will push it off so far that they can't push it off anymore. And then when the problem comes, it's just going to be like an absolute disaster. It'll be like what people were afraid that 2008 was gonna be. That'll actually happen, and like the banks will stop printing, and like the economy will just grind to a halt. All right, like that's what I worry about. But the Bank of Japan certainly doesn't help, because everybody since then has kind of started to enact these low and even negative interest rate policies, right? Here's something that I don't get. Do you think that there has been more income inequality? Which time period do you think generated more income inequality? I know I really hate that metric, okay, but it's like the easiest metric. We have the most data about it. So what time period do you think generated more income inequality? The periods from the 70s to 80s when interest rates were really high, or the period from the 2000s to 2020 when interest rates were unbelievably low? Because it seems to me that the financial system is able to take advantage of the low interest rates, and consumers generally aren't. Like, the one place where a consumer would benefit from the low interest rates is in being able to refinance their house for a lower price and pay less on their mortgage, right? but hardly anybody can even freaking buy a house now. You say both. Well, I really think that the 2008, post 2008 environment has been better for the upper class. Like, it's basically been like in the 90s, people were involved. Like, there was a lot of economic growth in the 90s, and I think that 80s and 90s, and I think that a very large portion of the American public was involved in that, right? But everything post 2008 has basically been tech companies and finance companies have grown, and everything else has stagnated, right? The rich got richer, and it didn't trickle down, right? It doesn't trickle down. If you put money into one industry, it's unlikely to trickle through to the other industries. They're kind of separated. You have to put the stimulus where it's needed. So I don't think that everybody's complaining about high interest rates, but the reality is that in order to fix this imbalance, we need higher interest rates. We need higher interest rates, and higher interest rates are the thing that now that interest, like, here's the thing. If interest rates were still low, I don't think that Joe Biden would be so ridiculously unpopular. Like, he would be pretty unpopular because it's very clear to everybody that he's just like out of his depth. But I don't think that it would be like the worst ever, like it is right now. Like, everybody's abandoning him. It's because the higher interest rates basically, like, all of a sudden the problems are right there in your face, which is good. I mean, because they need to be solved. Maybe it means that they'll be solved, but in the meantime, that's kind of like painful for people because you're going to get a lot of inflation. Well, I don't know if that 1 year, 2021, 2020, 2021, the inflation that we saw then is really going to be like, kind of seems like it's cooling off. But it could get worse because there's supposed to be another supply disruption here in midsummer. So maybe it gets worse. But that's kind of the way that I look at it. So then enters these people on Reddit. There's these anarcho-capitalist Austrian school of economic morons that come in and they're like, no, the Federal Reserve is the source of all of our problems. And if we just had a free market, then the free market would solve everything. No. Look, we had that system. It didn't work. That's why we got rid of it. That's why we invented the Federal Reserve, was because allowing everything to just go on its own didn't work. People's blind faith in the so-called invisible hand. It's, I think that the invisible hand is a useful economic concept, but the invisible hand is not God. Right? The invisible hand is not God. It gets it wrong. And we need to have the ability to come in and manually try and stabilize markets. And of course, that's going to have like knockoff effects, but it's better than just letting it go on its own devices. And we're getting better at it as we go along. Because the reality is, every piece of economic data that we have, every advancement that we've had in the field of economics is basically come from realizing that the market is not perfectly efficient. Is really what it comes down to. Von Mises himself was one of the biggest proponents to nudge the invisible hand via a central bank in his day. This continues as long as something bad happens that equalizes the playing field. I think that humans tend to overdo it, creating damage to the system. Too high interest rate messes it up. Too low of an interest rate messes it up and creates concentration of wealth. Yeah, Hydro. Well, like, the thing is again, the market tends to exaggerate things, right? This is why I've got a bunch of different themes on this channel, right? But one of the key themes that, like, the biggest one, the one that I've been harping on the most recently, and the one that I think has the most far-reaching and profound impacts on the rest of society, is realizing that markets are not informationally efficient. The problem is that we come in and we say this price right here is a fully accurate representation of all available information. It's not. It's not. And you don't even come even close to converging on that factoring in all available information until you get on like a 5-year time period. At which point they're like, there's so much noise on that time period. Like, is there really actually a different? I don't know. You know, it's just not informationally efficient. But all of the decisions that we make are based on this premise that it is, right? We use mark-to-market accounting to determine how much margin we should give people. It's like they've made money over here, and that's the price of the thing. So that means that they should be able to have this margin. But it doesn't work that way, because you use all of that margin up to buy other things, and then your other thing goes down, and you're going to blow up, and you're going to be forced to unwind it all. Right. And there's like some good studies that really prove this happens too. Right. It's not informationally efficient. So stop making all of the decisions based on it being informationally efficient. Right. And if we realize that, then, you know, maybe our monetary policy would have more guts to be able to say that, well, the market's being stupid right now. We don't care. You know, I think that's what the Federal Reserve should say right now. It's like, well, I know that the stock market is like super upset about it and everything, and is concerned that but we still need to raise interest rates. Right? Why? Because the market's not informationally efficient. Yeah, Bitcoin did pop in the end, didn't it? It's not a huge move, but it's enough to show up on my chart. It's a nice big up candle of about $300 or so. Activity in Bitcoin is a really curious thing right now, though, isn't it? I've never, like I said, the only time I've ever seen it this wishy-washy and like flat was like 2018 or so, when it went just before it like crashed below 6K. Bill has been introduced in the Russian parliament's lower chamber that would ban the use of cryptocurrencies as a means of payment. What? That's a little weird. So, okay, so in Russia, there's been all of these problems, right? And so they've been forcing people to buy oil with rubles or whatever it is. And that's kind of been helping their currency. But the reality is that currency market is no longer like a free market. But there's been a lot of speculation about that they'll be turning to alternative currencies, gold, silver, cryptocurrencies, et cetera, et cetera, et cetera. And that would put pressure on the Western financial system. So for Russia to be coming in here and saying we're going to ban the use of crypto as a means of payment is a little odd. Now, I don't know how their system works to know, like, is this actually like something that's likely to pass and is like really important or not? But that's just like a little odd. Oh, it could be that they want to just move over to mostly doing things in gold. I don't know. Treasuries are starting to move back down pretty aggressively, aren't they? And it's being led by very heavy selling in the 30-year. I'm not seeing a whole lot of other movement in the market to really clue me in on why we're going the way that we are, other than maybe a euro, right? Let's just come here on Twitter to see if I missed anything. GameStop closes up 14%. Meme stock's still running, huh? Polish central bank raises interest rate. Get ready for Euro USD fireworks. SFX Street. The ECB expected to keep rates unchanged this week. So did I misread my calendar here? Hold on. Am I missing something? Feel like I'm missing something. No dog, no barking. Oh, okay. It is Thursday. Thursday is the ECB press conference. And then Friday we got CPI. Okay, have fun with that Bitcoin trading Bitcoin hydro, but I'm just if you blow it and lose it all and don't make it to a 5-year mark because it was cryptocurrency, don't say I didn't warn you, okay? Because I can't tell you how many people I've had come in, like a lot. It's not like, here's the thing with the cryptocurrencies, okay? It's like I see people come into this channel all the time and trying to trade the NASDAQ, right? Happens all the time. But with Bitcoin, not only do I see a lot of people coming in trying to do like the market making stuff for Bitcoin, but like I got to know them really well too. Like a lot of these guys in the cryptocurrency market would like message me a lot. And I can't tell you how many of them that came around in like 2017, 2018 saying, oh yeah, like you can do great in Bitcoin, just doing like kind of market making strategies. And they did not make it to 2020. They did not make it to 2020. There's so many of them. It's just the kind of a move that you can have against you. Like looking at Bitcoin, crowing about making a profit in Bitcoin today isn't really is kind of like meh. Okay, Bitcoin has done what today? Where is it? It's down 1% today, I guess. Ethereum is. Where's Bitcoin? Now down 0.6%. You're talking about an asset that like declines like 10% in a day sometimes, right? So you've got this teeny tiny winner when there's been days that have moved like 30 times more than that. And did you catch those? Well, you've been trading it for like 5 years, and show us the results. I'd like to see that, because I've never heard of anybody in the cryptocurrency space, a retail trader trading on their own that lasted more than 2 years. I've never even heard anybody even claim that. That is insane. I always hear millionaire traders, they must be only a few present. Is that right? I really think that if you went and you looked at traders that have consistently made money over a 5-year time period in the last 5 years, there's probably only a few dozen of them. And of those few dozen of them, there's probably a good number of them that got lucky. That were just kind of lucky and won't make it the next 5 years. Okay, S&P 500 is retracing, taking a dive here. Oh, okay. So you don't count. You blew up in 2018. Okay. Well, Just be careful, because like what's looks like it's about to happen here is the same thing that happened in 2018, right? And I'm a little concerned that we're going to get the same thing that happened in 2018. You're so negative about trading all the time. Well, I think that I'm trying to be realistic with people about it, right? Like the thing is somebody has to do it, right? It's just what I don't like is the attitude that people come into it with is like, I'm just going to search the internet really hard and I'm going to find this one pattern that I can trade. And then I'm always going to trade that one pattern forever and I'm going to make money consistently. And it doesn't work that way. We've been given a conception of trading that is frankly unrealistic. Okay. Our idea of trading is based on success that people had in the early 2000s or so, before all of these robots existed, when the market was going through a once in a millennia kind of a change, right? That it simply doesn't exist anymore. And so I'm not trying to be negative like, you shouldn't trade. I'm trying to tear down the false idealization of trading that everybody has, right? And yeah, it probably should scare you off, because if the thing that you're looking to do here is to become a millionaire, then this probably isn't the way to do it, right? Because the people that are making millions of dollars, generally speaking, are people that took on excessive risk. And if you try and duplicate their methods, you're probably not going to duplicate their success, right? So that's why we bring it up all the time. Seth, how those hedge funds or others don't laws on trading? Do they get info that we don't have? Because many of us struggle with trading. Well, so for one thing, hedge funds do have, I mean, here's the hedge fund is actually like a really great example, right? Because first of all, top hedge funds, if you're like a top hedge fund and you're like trading one individual thing, okay, like a Renaissance technology, 30%. 30% a year is a good year, right? Like that's an insane hedge fund, okay? Most retail traders are coming in and trying to like, get 10,000% on their trading, right? Like that's their idea of trading is, I'm going to come in and trade this every day, and after 5 years, I'm going to have $1 million. No, I'm going to start with $100 account and I'm going to get $1 million. No, probably not, right? Like if you're making 30% year over year, you're like the top 0.01% of traders, right? So that's the first thing. Okay. The second thing is that most hedge funds don't perform that. Most hedge funds actually underperform the market or the benchmark or whatever kind of performance metrics that they're trying to find. Now, the goal of a hedge fund is not necessarily to outperform the market. The goal of a hedge fund is to be diversified. Okay, but most hedge funds don't actually have that, aren't that successful either, right? I think that the reality is that the kind of the profitable trader, the one that's out there that's like making money consistently year over year, etc., that everybody wants to emulate, is somebody that's trading at a bank and in reality is taking very, very little risk. They're putting, they're putting a few tens of thousands of dollars on the line when their stop is like 10 million, right? Okay. Like that's what a lot of, and really it's a minimal risk for them though, right? Like the amount of risk that they're taking on relative to how much they could take is teensy weensy weensy. And the way that they do everything, they spend all of their effort hedging all of their positions and etc., and reducing their risk to the point that it's practically zero. But when I say it, like it's kind of low risk, but it's not, because it's low risk, but the result of that is that you get these fat tails. So that's why you get something like Lehman Brothers, where a 2008 comes along and they just blow up, right? Okay. That's what they mean. Yeah, average return. Well, but in cryptocurrencies, that's probably a little bit of a different thing, right? But you still have to deal with in the cryptocurrency that it's like it's been mostly an up market. So we'd really, at that point, if we're going to say that works, don't quite have 5 years yet, but say you have 5, like if we want to start the hydro hedge fund and start soliciting investments to it, right? We would need to look deeper into the data, right? Seems like trade management and discipline are more important than the level of edge that you have, assuming that you do have edge. Not exactly. So like the thing is that trade management and discipline are kind of like baseline requirements, but you can have all of those things and still lose money, right? Trade with other people's money? Yeah, I mean, it seems to me like there's a bunch of rich people out there that are trading with other people's money and aren't really actually doing any better at it than your average retail trader is, right? But like now that we've deconstructed the myth, right? Why would you do it? Well, it's a good question. Because if your objective is to maximize your return, then you shouldn't be doing it. Like seriously, if your objective is to have as much money as possible, you are probably better going into a technology role or whatever you think is going to be the next growing sector of the economy. Maybe go into private equity, that sort of a thing, and make money from that and save as much of it as you can in index funds. That's going to be the most consistent, most likely way for you to make money. Why do you trade the futures? Because you like the market and you want to be involved. That's the only reason to do it. That doesn't mean that you can't hope that you'll make money, but let's just be realistic, guys. Right? It would be, it kind of sucks to have to tell you this, right? Like I don't savor the fact that most retail traders lose money. It's just that's my responsibility is to warn you that 95% of people that do this lose money from it. Oh, Kaka, thank you very much for the donation. But it is stupid if you do not trade, but it requires you to have an edge in your market. Well, I mean, like that's the thing. So if you are like me and you enjoy the market and you want to be involved in the market in one form or another, I think that there are kind of two things that you want to do or conclusions, I guess you could say, that you would make based on where we're at, right? Okay. Number one is that you do have to find an edge, and it has to be a pretty significant edge in order to make money. And because the market is more statistically efficient than it is informationally efficient, it behooves you to know as much about what's going on in the current market as possible. Okay. So that's the first thing. And the second thing is that because your probability of losing is really very quite high, it doesn't make much sense to put on a lot of risk. Because what most retail traders do is they come in and they put on way insane excessive risk, and they do okay trading it that way for a few years, and then the big risk event comes and they blow the account. This is what happens time after time after time again, is the people that seem to be most successful, they're generating the profits from taking on excessive risk. And I really think that what you want to do is the exact opposite. I think that you want to minimize your risk and maximize your edge as much as possible. That makes the most sense based on what we know about the current market. And I think that the bigger play here is you have yourself positioned so that when a new market comes along, when an opportunity comes along, you're one of those few people that becomes a millionaire from it, right? Because you were ready for it. But the whole reason that we got into this in the first place is that I just cannot recommend day trading Bitcoin. Sorry. I agree with you. I don't like these people who practically trade without stop losses. Yeah. Like the thing that bothers me about it the most these days is that I really feel like the people that are doing this, they trade that way primarily for the attention. You know what I mean? They do it that way because it gets them attention. Maybe they think that they're being successful and they don't understand the excessive risk that they're taking on, but they do it to get the attention. And then it places the whole retail trading community in this slump because they believe it. Right? And that's why ultimately to Live Action's question, I don't know, he deleted it. I don't know why he deleted it, because it was like a legitimate question, and it's actually a good question for discussion, right? Is that the reason why I bash on all of these things is because I want to get you guys to where I feel that I am, so that you can collaborate with me on stuff that really actually matters, that is really actually going to bring you somewhere, right? You understand market is more statistically efficient than it is informationally efficient. Then what are you going to do? You're going to go out and you're going to seek information, and you're going to say, oh, look, I found this piece of information that can help us trade the treasuries, and I found this piece, and we share it, right? Because we, as any one person, it's almost impossible, right? Especially if you're by yourself, because we're competing against multi-billion-dollar companies with thousands of employees to handle their infrastructure, right? We're going to have to team up a little bit to get something, right? That doesn't mean share what you know to the whole world, right? Like, that's the thing, is I don't necessarily share with you like explicit edges per se, right? I often keep the things that when I really think I know what's going to happen, I kind of keep it close to my chest at first, right? But what I do is what I try to do through the channel is I'm trying to teach you the base skills that you need to have, so that you can then go and start finding those edges on your own and do the research on your own. And the thing that frustrates me is that everybody gets distracted by this other bullshit. Taking on excessive risk, technical analysis nonsense, cryptocurrencies, etc., 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 Austrian economics, yada yada. And so they're not actually going in and learning the things that would actually be useful to us to bring us to the next level of trading effectively as retail traders, right? Or on the political side, the thing that frustrates me is where we have a market microstructure that is almost, seems to me, is like designed to work against retail traders. You know? That's why I talk about it, because it drives me crazy. It drives me absolutely batty that I am the only person on the internet in retail trading really talking about market microstructure and like proven quantitative studies about how the market behaves. Retail traders never talk about this. You will never see anybody, literally nobody on Reddit, talk about this stuff but me. If you see somebody talking about this, hey, the market is more statistically efficient than it is informationally efficient, that's probably me. You're going to look and you're like, oh, it's Seth. Right? Nobody else talks about it. They're wasting their time. Don't poop on crypto because you don't like it. I do. But that's part of my thing though, Hydro. Like, so yesterday on the Buttcoin subreddit, somebody posted this tweet where this guy was basically saying, like, one of the big problems that we have now is that there's this whole grift around hating Bitcoin now, right? Where people hate Bitcoin just because they can get on these speaking circuits and talk against it and be anti-Bitcoin experts. And I'm sitting here like, whoa, 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 whoa. How do I get in on that? Because I've been trying this whole time since 2017. I've been trying this whole time to be the one that's like, well, no, like there's a lot of problems with cryptocurrency, and I don't think that this goes up forever. And you know, I'm gonna trade it to some extent, but you know, now in the mania is probably not the time to buy it, right? I've been out there. I haven't made like videos about it. I feel like that if I make a Bitcoin sucks a video, that it wouldn't. I don't know if it would really help the channel, you know. But I want to be on that circuit. Listen, if I could spend my whole life, like if my income was bashing cryptocurrency in talks, I would 100% do that in a heartbeat. How do I get on the anti-crypto grift? I want to be paid to hate on crypto because I really strongly believe, I mean, it's been a slow process. I used to be like, well, I don't think that it's really going to work in the long run, but maybe we could make money from it, etc. And I've evolved from that to this thing is very harmful to mankind, and the sooner we can kill it, the better, is where I'm at with cryptocurrency right now. Okay, so do you ever think about trading microstructure? What is what live action is saying there? And somebody else asked, what's your auto lycus? What is that's a new name. Welcome. What is a definition of market microstructure? Okay, so when we're talking about market microstructure, what we mean is the rules of the market. How is the market set up? And how do those rules affect how the market behaves? Okay. And the largest field of market microstructure is the study of a limit order book. So when I talk about market microstructure, what I'm really talking about is the empirically proven stylized behaviors of limit order book markets, right? I have a video about that. It's called the stylized behavior markets or whatever, where I go through that. And this is like, you know, what people want to get from technical analysis. Market microstructure is actually like what the reality is, right? So the reality is we don't have these setups and contexts that necessarily say that it's going to go one direction or another direction. But what we do have is if you make a action, if you come in and you buy a certain amount of something, this is how the market is going to behave as you do it, right? So I can't look at a pattern and predict what's going to happen, but I can take a decision, a large volume decision, and prove pretty effectively how on average that's going to behave, right? And once you understand the market microstructure, the way that markets move with, you know, this whole oscillation back and forth sort of thing, like makes a lot more sense. It happens because of the market microstructure, because essentially there becomes a point at which the market makers become too strained and they stop providing liquidity, and it will create a liquidity hole where there's no liquidity being provided here. There's too much sell side liquidity here and too much buy side liquidity here. And so it just kind of gets stuck here. And what happens is these large institutions can actually execute a lot of volume in these spots. So they like to create them. And then when they've taken full advantage of that, then they will push it up to create another one. Right. And that's why you get this kind of behavior. It's also why, because you leave a hole behind you. So if you get one of these and then somebody pushes back against it, it's most likely that we're going to go further. I mean, that's what we're seeing this morning, right? Although I don't know if today is a very strong example, because I don't think that we're getting like really super conclusive meta orders. But you can see here on today's chart, you know, we had a really strong move down, but all of the volume was there. And so what happens? They get sucked back up into it. Okay, they split the difference. Another large meta order is coming in. It pushes us well beyond what the initial point is, because the liquidity is still damaged. And so you will see this kind of like expanding range kind of pattern is actually more like what the market tends to do. And that is kind of a little bit, no, we're starting to get into my own interpretation of it. But the empirical thing is that if you have a meta order down and then you have a large meta order up of equal size, you will end up with price actually being higher. Okay. It's very empirical. So that's what I mean by market microstructure. Now, when Live Action says, do you think about trading market microstructure? Well, that's kind of where the problem comes in here, because the market microstructure doesn't say if we're doing X thing in all of these metrics, then you have X probability if you go long of making money, and here's your expectancy. And yeah, it doesn't do that. It doesn't do that, because what do you need to know? You need to know what the meta order is actually going to be, right? So we need to rely on our other information, things about orders that we know could be executed today based on, changes in expectations, how different funds work, all of this kinds of information we can use to predict orders. And once we're able to predict orders, then we can use the market microstructure, because then we can say, here's what the current conditions are, and here's the order that we expect. So here's how it's going to play out. And when you know that, then you can start to find an optimal location to try and buy it, right? Like if we were expecting a large buy meta order to come in today, then fading that opening drive down would have been a great trade, right? So you'd know that it would come back harder. Now, I didn't have any reason to think that they were going to buy or sell it today. I feel very much out of the loop lately, but so that's where this all kind of comes from. And the difficulty is having that informational edge is really hard. You're not always going to have it, right? Sometimes I have it and it's like I can't lose. And then when I don't have it, the key struggle is minimize your trading. Only trade when you really have it, right? Getting better at it, but I'm not perfect. As long as you don't over leverage yourself. I don't see how you trade Bitcoin and don't over leverage yourself, to be honest. So there was a Forex funded trader program, whatever, right? And they put out some stats about like who their successful traders were. And the general gist of what they were finding was that the people that had lasted the longest, because what would happen is a lot of people would get funded and then they'd immediately blow out. Okay. This is a problem that all of the funded trader programs have that they don't really tell you about, is that the targets are so aggressive that you trade into it, you get lucky, you get funded, and then what you're most likely to happen next is you blow the account, right? But the people that were sticking around and were going for a long time were risking 1% per day. So like most futures traders, we say 1 to 2% per trade, and they're saying 1 to 2% per day. So if Bitcoin can lose 10%, right, that means that you have to have 10 times as much money to trade crypto. Prop trading is kind of a scam from them. Well, yeah, Top Step has the same problem. It's not really so much a problem with Top Step as it's a problem with retail day trading, right? Again, it's super hard. It's kind of rigged against you. You really got to know what's going on. Do you really want to put all of that effort into it when you can go and make money more easily somewhere else? For me, yes. Because I love the market. I don't know what I would do with myself if the market wasn't around. I love it so much. It's my favorite thing. And I very much enjoy and pride myself on trying to be an informed trader. And I would do it even if I couldn't trade it and there was no possible way to make money from it. I would still do it. Right? Otherwise, there's probably no point in doing it. Right? And like I said, I don't necessarily take joy in telling you guys that. It's just, it's the responsible thing because it's the reality. It's almost impossible to get funded if you don't YOLO it. Well, you can go and do a top step combine and just be really, really risk averse and do it over multiple months, right? But to hit the target in 1 month, yeah, you pretty much have to YOLO it. That's how I feel. There's a reason why the oil traders are the most commonly funded traders in the top step combines, right? It's not because they're so good at trading oil, it's because they're taking on excessive risk. Does Top Step has the Express account? That's Top Step? I know that there was a funded account. I think it was, I don't remember which one was. It was one that I had never been involved with, but I knew that there was some complaints that they were doing that, and some people felt like they had been deceived. But I didn't know that Top Step was doing that. Yeah, I don't think that the okay, so like we think of funded trading programs as a prop shop now, right? Like that's proprietary trading. I don't think that that's the right model. I think that the right model should be well, it's maybe closer to what Futures Trader 71 does, though, but I don't think that the information that they're providing over there is really the stuff that you want. But I think that what a prop shop should be is you pay $100 a month, and all of that money gets pulled together and is used to obtain research. It is used to gain access to professional research that you wouldn't really have access to otherwise, right? So the prop shop is basically a mechanism to try and even the playing ground between the retail trader and the professional trader. Because the thing that the professional trader has is access to all of this additional information that we don't. So if the prop shop was going and getting us, Wall Street reports, like you join the prop shop and you'd get summaries of like Goldman Sachs analysis or something like that. Probably wouldn't be able to go that far, but like that's the kind of stuff that we're looking for, right? And then if you're doing well, the prop shop could selectively choose to give you more money that day, right? They would know, here are the markets that we expect to go off. Here are the traders we have that are doing good. We're going to give these 5 guys extra money today to trade, etc., 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 right? The right model is to get clients and get licensed. Maybe. I mean, I do think that if I had clients, quote unquote, I could trade different strategies that I know work, but require a lot of capital to utilize, right? Kind of like, well, Ashk I don't think is trading other people's money, but like that's kind of the model there is like what Ashk is doing is very minimal risk, but the amount of money that you're making compared to the amount of capital that you have to do it is, insane. It's like you have to have millions of dollars to be able to make 100,000 a year, essentially. Top Step has started to give us well, they from time to time do programs. There's actually a definition of what a prop trading firm is according to the CME, and there are certain requirements. One of them is that you can't charge your traders anything other than CME fees. Oh, really? So then you can't. So you're saying that what I'm saying the model should be would not be able to be called a prop shop. Yeah. You know, like if I had other people's money, I don't know if I would even trade futures. I think I would be going out trying to trade bond specific strategies like, you know, well, there's a couple of studies that I've read. I can't remember the names of the different types of strategies, but there are things where you can trade forwards against themselves and stuff like that because they tend to mean revert. Or trade the basis in the futures would be another way of doing it, right? I think I'd probably do something like that. It's just you need like $1 million to do that sort of stuff. And you probably would want a Bloomberg terminal. So I am still on the path to get a Series 3 license though. So we'll see where that goes. I'm lazy. Yeah, I feel lazy. I didn't get a whole lot done yesterday because I was so tired, and I don't think I'm gonna get a whole lot done today. Not even pooling of money. Only money contribution allowed is from partners. All the costs, including losses, are borne by the firm. Well, I think that's what we'd want to do. I just think that it should be a monthly subscription so that you can get access to better information, right? The issue that I have with the Futures Trader 71 thing is that there's like lots of trader development and like that's all cool and they give you like these stats, but like you can get those stats on your own, right? If you go and you get the stats suite and you just program the extra metrics. I didn't want to like step on their parade, so I didn't include all of their metrics in it on the one they posted, but you can very easily make them in the stats suite, right? And then you'd get all of those and you could do that on your own, right? It's the fundamental information. It's the informational information that we want, not the statistical information. That's the stuff that's hard to get a hand on as a retail trader. You have a good track record, a lot of people will beg you to trade their money. If you have a 5-year track record, then yeah. If you have a 5-year track record, we could start a fund and people would beg you. Yeah, for sure. I've never come across somebody that I felt like we could do that with, right? I'm looking for the person. Hey, listen, you share with me. You have 5 years profitability. You share this strategy with me. I generate all of the stuff that we need to be able to present it to an institutional client, and we start a hedge fund. Yes, that's the way to do it, I think. Reality, though, is that most of what we're doing is taking on excessive risk. But you get what I mean? Like, so like here's another point, right? Like the spread in the micro 5-year is retarded. It's like an 8 to 15 tick spread sometimes. It shouldn't be that wide. Okay. And I could come in and I could say, well, here is what the correct on the run interest rate should be. And I'll bring the spread in a little bit. But to do that, I need to know what the correct interest rate actually is. And how do you determine that? Well, I thought that maybe you could use the future. And from using the future, you could calculate what the correct interest rate is. But as I've tried to do that, it seems to me that even within a few hours, the basis can change so much that you don't get a good estimate just trying to say, here is the 10-year. So what should the on the run be? Doesn't work. Can't get it to work. If you have some ideas on the math or you know the math for that and you think I'm doing it wrong, then let me know and we can fix it. But it seems to me that you can't do it from the Treasury. So what I think you really need is you need to be able to see the orders going through on BrokerTech and watch that one QSIP and then say, okay, there was an order just went through at this price. What is the yield for that? And then use that for your trading over here, right? Okay. So why is the spread so wide? Because no retail trader has the ability to do that. No retail trader has access to that broker tech data. If you have it, or you know where I can get it, please tell me. Please tell me. Because even if I decide that it's too expensive, I just really want to know where I can get it. Because I've emailed probably about a dozen people and none of them have been able to give it to me. Like a bunch of different brokers and stuff. Seth, say you buy ZN and have a 2-tick stop. Do you hit the bid as soon as it makes it there, or do you wait for the 2-tick bid to get thinner? I usually wait for the 2-tick. So you're saying if I am, let's say that I'm really stupid and I went long 070 and I have a 2-tick stop. So now they're at 060. Okay. Do I immediately bail? No, I usually don't. I would bail with it there being at like 400. I would probably get nervous. But yeah, I'm going to wait for this to, I'm going to try and play it as close as I can. You don't want that to happen where it ticks down 700 trade all at once and it ticks down on you. Now you have to go out at -3 and you can only do that so many times if your risk reward is like, because that's the thing is that on your shorts, this is like the nasty thing, right? On your shorts, the risk is that you get higher. You get more adverse excursion than you want. Whereas you put your limit order out there, you're going to get, if it ticks into that price, you're going to get it, right? So some volume trading at that price is not enough. But usually what I do is I have a stop limit. I usually have a stop limit that will be like 400 lots. I think I actually have mine at 300 right now, but that might need to be adjusted. But you know, that's just kind of eyeing the market and saying, okay, how low can that bid get before I have to be concerned about it, right? And then if it's a fast market, you kind of have to do things a little differently. That's why retail loses money. The edge is available, but they don't play it because it does not make enough to sustain their dream. Well, I would not put it that way, because the reality is that they don't have enough money to begin with to play it. Right? Yeah, it's much easier to make $1 million with $10 million. Yeah. The kind of the strategies that are like the truly consistent will make you money every day kind of strategies require a large amount of capital to deal with to begin with. Or another way to say it would be, if all you're going to do is trade one lot in here, that really limits what you can do. And I personally haven't found something that is so consistent that you'll make money every month from trading one lot, right? I've been able to keep myself pretty close to break even. I still make a lot of mistakes, and the issue is, how well do you know that market? When I know that market, I do awesome, right? And then it works. But if I, on the other hand, had $100,000 portfolio, then I could do what I'm doing here with this swing trade, right? Where when a single trade makes or loses $2,000 is no big deal, right? In your example, what if 06 flips before you hit it? Yeah, then you're screwed. Then you have to take -3. Now, I guess it kind of depends, but I'm definitely not going to wait and let it get so weak that then it trades 05 half, right? Now the thing that I have learned is that in this, especially in this volatile post-COVID world, 4 ticks, even 4 ticks is probably too tight, to be honest with you. Like here, let's come in here for a second. I'm looking for what is my average adverse excursion here in the 10-year as of late. I've been trading like a little excessive, so you know, I've been doing risky sim account only kind of stuff. So that would kind of give you a good example of how bad it can actually get, right? Okay, so if I come here and I say only ZN and let's I'm not going to go all the way. Let's just do just this year, okay? Just this year. ZN. Okay. I don't know if this is actually going to give me worthwhile stats. Average MAE 6.9, average MFE 11. Yeah, that's about right. So right, it used to be that I could do 2 to 4 ticks, and now you need to be like 6 to 8. Which, I mean, it's okay because it trends, and so it's probably, but I don't know. Like, here's the other thing though, is that there's kind of situational stuff, right? Like, I think that the best trades are the ones where you can get in, and if it doesn't just immediately go, you can just scratch it, you know? The problem is that not every trade is going to be like that. Like, if you really were that selective, you would hardly take any trades, and you're not going to make money. So I don't think that you can be that stingy. But I mean, I would trend towards that side of things, that I want to trade where it should immediately start to go my way, and if it's going more than 2 ticks against me, then I don't want that trade, right? But if you were just saying I'm going to stay in for 30 minutes and I'm taking all these random trades, then you would probably need like a 6-tick stop, because you could have a 6-tick move against you that's just a freak move that is completely counter trend and doesn't matter. So that's how wide your stop has to be before you're like outside of just the noise. If it flips up, I pay for. Well, no. Like, so I think a better example would be the 1-tick trade, right? So if I wanted to go long, I think right now I'd want to go long. If I catch the edge at 06, okay, and it ticks up, okay, I could scratch it at 06, or I could be looking to, or I take the profit at 06 half 07. So I'm taking 1 to 2 ticks of a profit, right? If it now ticks back down, okay, or it doesn't tick up, I'm potentially looking at hitting into 05 half and losing a point already, right? And if I don't do anything, okay, so I'm filled. Cool. If I don't do anything, then I lose -2. Or maybe I lose -3, right? Now all of a sudden, your win rate has to be really insanely high. And are you going to be able to get like an 80% win rate on a 1-tick trade with that tight of risk parameters? There's no way. There's no way you're going to get that. So if that's the sort of thing that you're doing, just when you take from that perspective, you kind of realize how tight you really have to be. Okay. So now let's take it out and we say, okay, but what if I'm like 6 ticks, right? If it's 6 ticks, I can much more afford to say, okay, yeah, if that price gets even touched, I want to mark it out, you know, then you can get away with that sort of a thing. But when your profit is so small, you don't have much leeway. So if you read Misbehavior Markets, I haven't heard of that one. Just have enough to martingale 26 times with 5% stops, no stops or losses. You get I tell you what, one of the things that I've learned from, these experimentation that I've been doing since 2020, where I'll try and take swing trades or trade with multiple lots and stuff, is that most of the time it works, but when it doesn't work, you're gonna get creamed so hard. You're gonna like Martingale. Martingale works 99% of the time, and then that one time that it doesn't work, that's the account. As you said yesterday, it's easy to make money, but hard to keep it. Yeah. This is a pretty solid move up we're catching here in the treasuries, don't you think? I'm a little surprised though. We're not quite to 3% yet. So, I don't know. Like, here's the thing though, is that I wouldn't, it's not like never take on risk, right? It's just kind of like you kind of have to know how to mess around with it a little bit and keep it within the context of the trade, right? Like something that you could do, that you can do in this market in the treasuries that I've found can work really, really well, is come in and just take a base trade to kind of fill things out, right? Maybe I went long 07. I'm catching a little bit of something. I try and let that ride, right? But maybe it goes 2 ticks against me and I say, well, that's not supposed to happen. So I flip around, but this time with 2 contracts, right? Now, if that 2 contracts one doesn't work, then I'm done, right? I'm not going to martingale it more than that. But martingale it once or twice, yeah, you can do that. And there's like a limit to it. And you'd still need a large enough account and everything. But like you got to realize that taking on risk is kind of like our advantage. Is just that if you take on risk indiscriminately, then you're guaranteed to blow up, right? The same thing with like all in and take sequential profits, and your first sequential profit is closer than your full stop out. This is another way of playing with the risk. And if you're doing it in the right kind of situation, that's going to help, because what it's going to do is it's going to get your win rate up enough that you kind of have like some room to work, right? He said hedge funds hardly risk much and they hedge it. Well, I don't know if I would say it's hedge funds, but it depends very much. Let me qualify that a little bit better. Okay. The reason that Goldman Sachs has been around for like over 100 years and makes money so consistently and so efficiently is because they take every measure that they can to eliminate the risk. And their optimal trade is the trade with 0 risk. If they can come in and they can arbitrage it and take no risk, is just immediately you spread the difference between these 2 things and make a cent profit or whatever. Like they're going to do that sort of a thing, right? So that's the most solid channel, even though he hates all crypto in his agreement. Thank you. You even have requests for quote trades where the guy makes 100 delta spread and hedge it outright in the futures, but now they are hedged to their upside as well. So how can they make money? Well, it's arbitrage, right? So you're making this teensy weensy little bit of money, and then you take out all of the directionality of the trade by hedging it. And you have to take on inventory. So you hedge yourself so that the thing can move and you can take on inventory without actually having a larger position, right? I don't understand how all of it works, especially not when it comes to like using options. But was Yellen testifying today? I feel like I've heard so much about Yellen, and I just don't find it all that interesting. Yeah, I think you probably can do it with interest rates. I think though with interest rates, it's kind of more like you're going to buy the actual bonds, right? And it's kind of hard to. Maybe I'm wrong about that. Maybe if I found the right broker, I could do that, because bills aren't in the treasuries. In the treasuries, your a contract controls $1 million or whatever the deal is, right? So if you wanted to be buying bonds over here and then hedging it with the futures, like, you can need a couple $1 million. But if I was just playing different CUSIPs of bonds against each other, I don't think that I think you can do them in increments of 1,000. So it might actually be possible to do some stuff over there. There might also be more opportunity than we realize in like over-the-counter markets. But here again, I think that the issue isn't that these strategies aren't theoretically possible. I think the problem in those instances is getting access to even be able to really even try those strategies, right? It's like, I'm looking here. Okay, there are some markets where I can see I can buy bonds and stuff, but I haven't seen one where the quality of the data and the execution and everything is enough that I'm like comfortable doing it as a retail trader, right? So I can very easily see in here. I don't know exactly what they are. Like, I've never bothered developing these strategies because I don't think that I can trade them. But I'm sure that somebody from Goldman could come in and teach me how to do a strategy with the bonds, and I could probably consistently make money with it, right? If I had, and if I was trading for them, for instance. It's like, it's really, the issue is like the limitations of a retail trader. And the places, like, that's the thing, is like Wall Street only lets you compete against them in situations where you don't stand a chance, right? If it was a place where you stood a chance, they don't want you trading that because they're trying to make as much money off of those as they can. They don't want competition. So they're not about making access to those markets easier for us. It sucks, but that doesn't mean you can't make money. It just means you just kind of have to put it in context and use that information to determine what you're going to do, right? You're not familiar with locked or cross markets. That's a term I don't think I've heard before. Yeah, the trade would be you already having one leg or locating one leg cheaper than what you already quoted. Exactly. Like, or trading multiple markets. I mean, like, the easiest example of an arbitrage is just I'm trading multiple markets, and this one is cheaper than this one, even though they're the same thing. So buy and sell at the same time. Talk about what you're doing for your long ZN. Well, I'm short ZN. I'm short ZN, and I'm making a longer play that the bond yields might move to 3.5. If it comes back to my entry location, I might have to scratch it. But right now, the move that we're seeing today, I'm not seeing anything like. Obviously, it's moving and the order flow is moving and you could make money from it, but I don't see any signs of real informational content behind these moves. It looks to me like you have a tight market that doesn't really want to go anywhere before the CPI, but there's still some people that have to execute some large trades, and they're large trades that I'm not able to predict. And so I'm just kind of chilling, watching it. And if I see a move, like say we have a really strong move up, and I'm like, well, that doesn't make any sense because in the long run, interest rates are going to go higher. Maybe then I add to it and try and scalp a little bit out of the range or whatever. I think it would be nice to be able to. I mean, look, for them to stop me out, it has to go to 119.28.5, right? So I have, like, that's the cool thing, right? This is how you can mess with the risk, is like you can take the risk for a very brief period of time and then use what you made there to try and give it more room to breathe. Oh, yeah. That's great. It is high risk though. When it doesn't work, it's really ugly, but you often find yourself it coming back to your break even and being disappointed. That's hard. But throw the books out the window. The guys making it aren't sharing. Well, so here's the interesting thing with books is that there are a lot of books out there that really do have some valuable information in them, and that you would read. Like there are books that are designed for, you're a newbie starting at a bank and you need to learn the basics of the interest rate market, and here's how you do it, sort of a thing. Like people teaching quantitative stuff about subjects that you would never need unless you were working at a financial institution. So there are definitely books out there with like serious information in them. But like for one, nobody in the retail space are talking about those books. And two, how applicable it might be to any kind of a trade that you can take as a retail trader is questionable at best. Right? So... across market on SPY would mean best bid on level 2 is above the best offer on the ask for a split second. They occur in moments of high. Oh. So you may be talking about a situation where your best bid is higher than your best offer because of some of the bizarre behavior behind how stocks work. Yeah, I'm not really familiar with any of that. There you go. Good books don't tell you how to make money. They tell you important information that you can apply to trading. Yeah, I think so. So it's like you get the base level information and then you can kind of, it's up to you to figure out how to turn that into a strategy. Yeah. But it also dampens your directional reward for that time. I mean, I think if you're doing that sort of a thing, I think that you want to be long theta, right? Sorry, so in this in this theoretical options trade, what property do you want to be long? That's the way that I would think about it, right? Is like, if I'm just taking, if I just go in and buy calls, right? If I just go and buy calls, especially if I'm like far out of the money, I'm going long delta and gamma, essentially, right? If I come in and I sell options and buy the underlying to hedge myself, then I'm trying to go short theta, right? Do we call that short theta, right? Because you're making money from the theta decay, essentially. The 6 Pillars of Self-Esteem is the best non-trading book. The psychology place is interesting because that's a place where it's a lot easier to see the applicability for trading. Maybe that's why there's so many books about psychology out there. But for all of the books about psychology out there, it doesn't seem to be helping retail traders, does it? That's why I'm kind of like, you have to consign yourself to the fact that what we're trying to do is kind of hard and possibly tilted against you. And if we really want more retail traders to be successful at trading, the answer is probably that the market microstructure has to change, right? Otherwise, 95% of traders are still going to lose, and you're going to have to do extraordinary things to be in that 5%. And that's what we want to do, is we want to be in that 5%. But you've just got to realize that the difficulty, the extravagance of what we're trying to achieve. Right? If I want to be long, yes, the options trade has to be somewhat short in delta and long in that theta. No, I think you're long delta in that instance, right? Because the more that the delta increases, the more money you make, right? I don't know. I'm probably getting all of the. I'm not an options trader. That's kind of an out of nowhere question. Oh, he's just somebody's linking. D is sharing with me the ATAS trading platform. They have like a speed of tape indicator of some sort. Looks like something that I could probably duplicate, but they're not. They're just vague enough about what it's doing to, you'd have to reverse engineer it. I got to tell you, I could probably make just about any technical indicator you can possibly think of. And in the field of order flow, there's lots of room for more indicators to be created, but I'm extremely skeptical of how much edge such a thing will provide for you. I think that there's kind of like a minimum standard. Like the things that I put on my website, on the Speculator Seth website, most of that is stuff that's like, I feel like you should have. Like, I have a hard time seeing you being successful without having that information, without being able to see the spreads in the dollar in particular. It's like, what are you even doing? Right. Some of the other ones that are in there were kind of for fun. But, and then there's there's the positioning indicator, which is really, really interesting. And I really thought that maybe we would be able to manage a statistical automated trading strategy off of it, but I haven't been able to find something really good with that yet. So but it's still useful. I always have it on my chart, and I think it does a very, very excellent job of kind of telling, like I give you an example right now. I don't know if I have to justify the indicator to you, but we're between the blue and the orange. That's kind of the neutral zone, and we've been spending most of our time above that. So it looks like buyers are mostly in charge of the market, but they don't have a very strong command of it, right? Yeah, it's like the second time this month, isn't it, that we got spam. Anyways, so that's kind of like where we're starting to get into fuzzy territory, where it's like, how much does that actually help you, right? And I think that a lot of people think that the indicator is the thing that's going to do it. And it can, but the chances of you finding that is like practically none. Like the thing that really helps you is the informational stuff, right? How does this market work? What are some things that we might know about the market that could predict future orders, right? Stuff that any piece of information I can get that doesn't come from the exchange, any piece of information I can get that doesn't come from the exchange, that's what I'm interested in. That's what I think is going to give you, is more likely to get you a leg up, right? If it goes very in the money, the SPX option will start making losses greater than the ES profits because ES is 50 and the SPX are 100. Recommended to get those to get more negative delta. The HK knows this, actually does this shit. he knows how to do something like that. Do you really think that? So if you traded 2 ES though, so you traded 2 ES and 1 SPX, you think that would actually work? Or that seems to me like something that there wouldn't be a whole lot of room left for. Like, it's just, if I wanted to come in and I wanted to do an arbitrage trade, That seems like that would be the first place that you look, is like, well, let's go and try and arbitrage the most popular instrument out there, right? You're probably not going to find many opportunities there. But there are divergences between the cash and the future in the SPX, right? There are some points at which there is enough of a statistical anomaly that algorithms will aggressively try to trade it counter trend. So there are people doing it, but historical data is meaningless. And yeah, you don't want to base all of your analysis on the past. This is something that really bothers me about price action. This is why I hate price action so much, because they claim that they're not using historical data when they really are. It's really is just technical analysis in the end. It's not any different. It's technical analysis rebranded, right? If you were looking at current market information, basically what that means is if I'm going into NinjaTrader and I'm writing something, I can never do close of 1 or anything other than 0. I can only look at the current price. And if I start to look at any other past price in that chart, then I'm using historical information then at that point, right? So I could come in and I could look at the current price of a whole cluster of different assets and make a calculation about what this asset should be based on those, and I'm using all current prices, right? And then that's like real market making, right? Only using current data. But as soon as you go and say, okay, how big is this candle compared to last candle and yada, 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 now you're using historical data. There's somewhat of an edge in historical volumetric analysis. Well, okay, yeah. So the distributions, the Gaussian distributions that occur in the volume profile are what I would call a stylized behavior of markets. It is really more the effect of the other stylized behavior of markets that we've talked about that kind of cause it. There's whole thing about like the previous day's point of control and all that sort of a thing. I haven't really been able to find reliable statistical anomalies in those. And the people out there that are claiming that they have statistical anomalies on that and that you should trade off of them, in almost every instance that I see, they are not using a large enough time period and they aren't factoring in risk to those assessments. It's all very interesting. I would be so here's a don't answer it now. Think about it for a day, because we gotta go. But a question for Ashk is what would be a consistently profitable market making kind of strategy per se? You know, like you trade euro dollars, right? Okay. Like I like what you're doing. Like that's the sort of thing we're talking about, right? What would be the cheapest one to do? Like what would be a strategy of that nature that you would think requires the least amount of capital? I'd be interested to know. I don't know how you, so the least amount of capital, but I don't know how we put the other, that other qualifier on it. So could we call it that it's like an arbitrage trade or a market making kind of trade? I don't know. I don't know how to put it, how to explain it, but actually no, let's explain it this way. It's a trade. It's a trade. We're trying to use the least amount of margin that does not expose us to directional risk. Right? No, not just providing quotes both sides of the bid and ask continuously. I don't know. Like what you're doing with euro dollars, it sounds to me like you're kind of taking advantage of a mispricing, right? Maybe you could do this in spreads to some extent, but I think that there's still directional risk in spreads. So I don't think that spreads is the way to do it. If there's a way to do it in spreads that really gives you like a high probability of making money that we can duplicate here in the micros, then we should probably be doing that. I feel like the last 3 days I've said something about spreads and I'm like, maybe we should be doing that, except for that the spread in the 5-year sucks. I don't know. Yeah, with the least amount of risk in your judgment. Actually, let's make it more broad. Trading strategy that you think would be profitable over 5 years and is the least amount of risk to put on. Or and when I say the least amount of risk, I mean like you could do it on a tiny account, right? The CFD broker with a low spread real market arb that to the moon until they ban you. There you go. Trade ZT against matching 2-year out SR3 ED quarter trade. I don't know what SRD3, what that means. How much would you need for that? Oh, those are the SOFR futures. Durr. Well, that sounds reasonable. Oh. Whoa. So you're saying you trade the 2-year and then you go and find the SOFR future for 2 years out and you trade the difference between those two because they should be roughly in line. And it would only require 500 overnight to do that? I am surprised. Maybe that is the way to go. That sounds like something we could do. Except for that I don't have SOFR data. Well, we should message NinjaTrader about that because I think that we should be able theoretically to get it, right? I just think that like nobody does or something. I don't know. Hey, we should ask EdgeClear about that. I haven't messaged EdgeClear about the other stuff. Read my example. Let's say you provide the ask for a call option in weekly ES options of delta 20. Someone hits it. You hedge it by buying 2 micro ES contracts, 20 delta. Yes, but if you hedge it, yeah. So here's something about these strategies that I never understood. Is like if somebody hits it, you're buying 2 micro ES contracts, right? You're paying up because you're using a market order, right? So that means that the option that you're like the price that you're looking to get filled at has to be a little bit away from the current price, right? So I don't know how the professional market makers deal with that problem, but like if I was going to do this with micros, like, you know, kind of makes sense how you would want to have like a 10 tick spread, right? So it would be like, well, okay, if you want to pay up 10 basis point, you know, if you want to pay a whole basis point up for it, then sure, I'll let you hit me and then I will pay down half a basis point in the actual cash and just make half a basis point on the trade. Yeah. That would work. if you actually got filled. I think you need to scan for opportunities, and once one is available, you take both. That's probably the case too. But I think that might be why in most markets there's always these orders that are kind of following the market around like 2 or 3 ticks out. Is that they're hoping for somebody to just sweep through the prices and try and take 3 prices at a time, and they can mark it over in the other market and take it out. Best time to place this trade is usually during the Singapore market hours? Really? Well, that's actually probably better for a lot of retail traders. And we'll see where we can get that data. Sounds fun. There's gonna be huge competition. Yeah. Okay. Let's change it. And really, I'm like 20 minutes over now. I should go check on the wife and kids and take a nap. Oh yes, nap. You're gonna trade the micro futures, the micro treasury futures. How would you do it? I'm trading them outright, so we've had a little bit of success with them. I kind of want to start trying to do something a little more complicated. Yeah, like maybe a spread trade. Maybe there's a mean reversion in the spreads that we should be trying to trade. I don't know. We'll see. We'll see. There's a whole mess. I have a friend. Yeah, well, it's for sure. Like, something again, going back to this whole thing about the SEC is going to change some of the rules. It seems to me like there are a lot of things about the market microstructure that exist today, not because that's the best way to do it, because all of these things were invented like 30 to 100 years ago when we didn't have electronic markets the way that we did today. And the only reason that they still exist is because there's all of these people that have dominated those markets and have made money, and they have a vested interest in keeping it that way, right? Otherwise, we could make the market more efficient in those cases. And so you've got all of these situations where hedge funds are putting together all sorts of crazy stuff. Like again, there is a way to bring the spread in here in the 5-year. Is just that it seems like the data that you would need to really do that well is not really available to retail traders. And the person that has the money to do this doesn't want to do it because they don't really make any money from it. And I'm sitting here like, there's got to be a way like that. Sounds like an opportunity to me, doesn't it? Sounds like an opportunity. But we've got to get that broker tech data. I think I have to get broker tech data to do this, unless there's really is a more reliable way to guess what the interest rate should be from the future. But it seems to me that the data that we have available to us isn't enough, because the basis changes too often. Yeah, there's their game theory behind hedge funds trading. So long as everyone competes for the same edge, the game continues once someone pushes closer to the edges. Yep. Because there's an optimal amount. There's an optimal sizing for any inefficiency in the market. And once you trade over that optimal size, you are essentially introducing an inefficiency in the other direction. And that can ruin the trade. And that's why you get these situations where like all of these quant funds all blew up at the same time and that sort of thing. Although a lot of it is fooled by randomness, right? Taking on excessive risk and not understanding the long run consequences of your strategy. Anyways. The spread. I feel like I could do more research on the spread. So think about that. What do we want to test on spreads to see what maybe we could make some money from? And hopefully that would be something that would maybe allow us to bring the spreads in these down without knowing what the correct interest rate is. But I don't know. It was strong. We're getting a really solid uptrend now. Maybe the 10-year auction is going to go well today. I think if the 10-year auction goes well today, that could really change the market up a little bit, don't you think? So we'll see where, I'm going to sleep. I'm going to sleep because I want to take a video. I think that I would look terrible today. Look at this. Oh my gosh, my face. I look tired. I do. I look actively tired. I need to trim the beard. Guess we can do that today, tomorrow, whatever. Yeah, I think I want to. Well, maybe I'll just record on Friday. I already got everything ready. I just got to do it. But I need to do it when the house is quiet. Right now, it's not quiet. I can hear the baby crying. So stay profitable, friends. Don't lose it all.